the responsibility and role are very different. The manager are the one that execute, so they run the company and are like the executioner of the company potentially, because they can drive the company bankrupt or they can drive the company to the start. But they need to be managed like horses by somebody else. Who is this somebody else? Is the board. The board is the entity at the top that supervises the manager, chooses the manager, replaces the manager, and joint with the manager crafts the strategy. The owner are a different set of people, because the owner are the people who own the company and get the benefits from the company, the dividend and the profits. Owner may sit in the board or may appoint other people to sit in the board. So you may think that as a division of labor, the owner choose where the company go, choose the mission of the company. The manager choose how the company goes there. So they choose the goal, the strategy. And the board acts as a chain of transmission that checks whether the strategy and the goal are aligned with the mission. So fundamentally, it's a division of labor. It's very, very different. If you think about a privately owned board, it's a board in which the governance takes place in the board, and the board monitors the manager and selects the manager. In a listed company, very often the big owner of the company are the institutional investor. If you think about company like BlackRock, BlackRock manages around $11 trillion of assets under management, Fidelity more or less 10 trillion, Vanguard 10 trillion, and State Street 9 trillion. So these four people manage $40 trillion of assets under management. So most of the company listed are owned by this guy. This guy never sit in the board, they don't want to sit in the board, and potentially they don't even want to vote in AGM. So they don't monitor, they just simply diversify away the investment. If the company is good, they invest. If the company is bad, they divest. The company's stock price drops, and the manager are replaced by M&A. So fundamentally, the difference is very big. In a private company, the board supervises, manages the manager. In a listed company, the board plays a completely different role. It's more compliance, checking, but the good governance is provided by the financial markets. So the good governance people are the short seller, the activist, and the player in the market. Fundamentally, the main risk that the board, the new board that wants to create value should be paying attention is to prevent the company from becoming obsolete, irrelevant. If you look at the stock market in the US now, most of the companies used to be there 20 years ago are not there any longer. They become obsolete. The board have not been able to challenge the manager. And what does it mean to challenge the manager? Does not mean asking the manager, why are you bringing me the decision to buy this company? What are the risks related to buy this company? But asking the question, why you're not suggesting to do something else? For instance, the company is sitting on many divisions. Why you as a manager are not suggesting me to sell off one division? Because the manager, if does not suggest that, somebody else, an activist, will force the company to do it. So the key question the board should ask is, what will happen if we don't do? So the main role of the board is to challenge the manager, not on the actual, but on the counterfactual. Counterfactual means the alternative scenario that no CEO will ever like to bring to the board. To protect the company as a fiduciary duty vis-a-vis the company, and that's to lay out the structure of the company. But the board is set up after the company has already been created by the founder with a series of bylaws. And the board operates within the structure of the company, including the structure of the board, including the control structure that have been selected by the founder. But clearly, the key role of the board in terms of control is not only compliance, but checking that the mission of the company desired by the owner is implemented. And that means that they have to navigate a very complicated path when owners are of different type. If you have family and private equity, they are fit with each other like a drop of oil in a bucket of water. They don't glue. The mission are very different. So the key role of the board here is how you operate in a structure in which the owner have incompatible direction in which to go, different mission. And that's the role of control becomes very tricky because the owner are split and the board has to operate with split ownership. And that means that if the objectives are very different and the CEO cannot achieve them, the company may be subject to takeover by activists, and activists reestablish for the company the original goal of the set of owners that were neglected by the manager. So fundamentally, the board, if it's good, will prevent the action of activists. A weak board means not implementing what the owner wants, means some new owner will come and will enforce. These are the activists. To implement what is the best source of value creation for the owner, conditioning on preserving the value of the company. So if you are a family firm, and in the case of a family firm, selling off asset means getting cash out of the company and facing the risk of not knowing what to reinvest, the role of the board clearly is to preserve the value of the company and very often preventing the manager from selling off. But if the owner are people like BlackRock that know how to reinvest the asset, where clearly the role of the board is to stimulate the manager to create value for the BlackRock that the game, generate cash that can be passed on to BlackRock, and potentially BlackRock finds better investment opportunity. So if the company is listed and the owner are BlackRock, Fidelity, the big institutional investor, share repurchase, selling off the asset is the best way to create value. If the company is a privately held company, family firm, share repurchase may not be the best idea because the wealth of the family is better preserved within the company, which means the board then will take care of the company and will push less for share repurchase, selling off, and divestiture. I think the most fundamental challenge is happening is, if you think of the governance, is moving more away from corporate governance to security law. What do I mean? What I mean is that the number of stock listed in New York Stock Exchange now is way less than what used to be 20 years ago. Companies start pulling out of exchanges and stay private. Private means private equity, or may mean the new security token or new form of fintech. But in this kind of situation, voting rights are not given to the shareholder. If you don't give voting right to the shareholder, the only way to supervise the manager is to resort to security law. So it's not corporate law, but security law. Within this context, the role of the board is practically zero. So we are moving from a society in which you were managing the CEO using an effective and very powerful board, because corporate law determines how the board supervises the manager, to a new system in which you don't necessarily need the board. It's enough to have a very well-functioning market in which big investors like BlackRock buy and sell, and the disciplining device is provided by the market. BlackRock will not sit in the board, will not necessarily want to vote, which means voting rights and traditional government are changing. So the bigger challenge is, how does the board now adapt to a new reality in which the power of the board is less required in this context? Well, the future for board, it will be very different if the ownership is a family, which means private held company. The board will become even more important to create value. And for this company, the crafting of the strategy is moving more and more away from the CEO to the board, to listed or company on blockchain, in which the role of the board is much less important, because what matters is the role of the financial market. So you're going to get a diversification between different type of board. The board in the family supervises, manages the strategy, and jointly determines with the manager the strategy. So the board will be more and more hands-on. The board for the other type of company is more compliance and will only care, mostly care that good information flows to the investor, the BlackRock, the game. So we are talking about transparency, we are talking about disclosure, we are talking about security law, but we are talking less about intervention and crafting strategy joint with management. So I think the best example we can consider is, pick a bank like Citibank. Citibank is a very nice bank that on average regularly every 20 years goes bankrupt. The question is, does it mean that it's bad governance? The fact that Citi goes bankrupt every 20 years, is it a signal that the board is not good and the investors are stupid? Well, compare Citi to another bank that went bankrupt in 2008 similarly, Fortis Bank in Belgium. Did both of them destroy value in the same way? Well, the answer is, let me look at who owns Citi. Citi owner are people like BlackRock. How many banks BlackRock owns? A lot. It's more than 5% in most of the big listed banks. If I own many banks, it's very similar to me owning many lottery tickets. The payoff is the most important thing. I want the CEO to take a lot of risk. My way of thinking is, I have a lot of banks, 50% of them go bankrupt, 30% break even, 20% I make so much money that I'm happy. So I want every CEO to take a lot of risk. I am okay if 50% go bankrupt. Fortis Bank was owned by a family. A family has all the eggs in the same basket. If Fortis Bank goes bankrupt, I lose everything. So the value creation for a family is very different from value creation for BlackRock. What is bankruptcy and seems to be very bad for a family is the rule of the game that you accept is the ownership is made of BlackRock. So what's the main lesson for the governance? Well, the main role of the board is to select a CEO. If you take the CEO that was very well groomed to manage risk in Citi and you place at the helm of the family firm, you destroy everything. Because somebody that manages risk Citi style will create a lot of distraction in a family firm. The existence of players like BlackRock, Fidelity, Vanguard is very good because at the end of the day, what is a share repurchase? Is a reallocation of cash from an industry to another industry. People define in some country hedge funds locust, like the mythical plague of Egypt, because you buy a company, you turn it around, you split it up, you sell it off, you get cash, and you give cash to the shareholder. But what people don't understand, that cash is used by the shareholder like BlackRock or Blackstone to put investment in new company, AI company, fintech company, new tech company. Where does money come from? From all sector. If you don't have this set of intermediaries, the CEO that are so much in love with their old business model will keep on investing in more and more and more stupid project, and much less value is created. Creative destruction is what Schumpeter used to say is at the base of capitalism. That's exactly what BlackRock and Blackstone are doing. So fundamentally, I think these are the good guy of governance, the BlackRock, the short seller, the hedge funds, because they impose discipline on how capital is allocated.